Welcome to Deloitte's Debrief Tax Series webcast in Asia Pacific. Our webcast today is from our corporate income tax series, and it is entitled Supply Chain Resilience in a High-Tariff World, Best Practices in Strategy. My name is Sarah Chin. I am a tax partner based in Deloitte in Hong Kong, and I have the pleasure of welcoming two friends and two colleagues in today's webcast. The two speakers with me today in clockwise direction is Mike Nixon and Dolly Zhang. Mike is my fellow partner based in Singapore, specialized in transfer pricing. Dolly is a partner based in Shanghai for Deloitte China, specialized in customs and global trade. You may access our bios on the left-hand side of the screen. Now, before I introduce the agenda for today's webcast, I'd just like to take a moment to highlight some of the features of our webcast console. First, all users are on listen-only mode. If you have any content-related questions, you can submit them at any time in the Q&A box at the bottom right-hand side of the screen. We will do our best to respond to your questions during the presentation. Second, all PC users can maximize or minimize each box at your own convenience during this webcast. You may also explore the icons at the bottom of our screen. If you would like to download today's slides and related publications, please go to the Downloads and Links box. On the other hand, mobile device users can view the slides and answer the survey on screen. Thirdly, if you require an attendance record for this event, you will receive an automated email with the CPE certificate after watching for 50 minutes. So with that aside, I'd like to just quickly move on to the next slide, which is showing you the agenda that we have planned for today. We have quite a lot to get through, so the sequence will be mainly focused on the item number 3, which is the key tariff and transfer pricing considerations, but we will begin with a little bit of the setting of the scene and really summarizing what we're seeing from our clients and what we're observing as the responses today. Dolly and Mike will take you through some examples of some of the levers that you can consider from a short-term mitigation perspective. Please feel free to put in any questions that you have, and we will take those questions and provide the answers as much as we can. So without further ado, I'd like to quickly move on to the next section, which is really just to set the scene for today. Thank you, Perry. When we talk about supply chain, we've seen certain shifts which have happened globally around the world. We've just picked on 3 examples that we've highlighted here. So you are all very familiar that there's been a lot of geopolitical tensions around the world, a lot of conflicts. There are some humanitarian issues which has disrupted the classical supply chains. It's forcing certain usual trade shipping routes to be rerouted and looking for alternative ways of sourcing certain products. In recent years, the economy has been slightly uncertain, I would say, and we are observing that companies and all our clients have to make choices in terms of where they put their investments and prioritizing those choices. And lastly, there are lots of new regulations, complicated regulations, which have come into play that will also affect supply chains. So we have seen a lot of sanctions within the last year or so. There are more export control regulations coming up, which are becoming more and more important. There are sustainability matters, data management. I can actually go on, but I won't. But this is really all adding to the management of taxes and regulatory matters, which is also adding to the costs. So if I move on to the next slide, we are talking about tariffs, which has really been news or top of the news in the past few months. But I would have to say the tariff discussion really began several years ago. Probably the first time it really hit the agenda for everyone was back in 2018. The prompt or the trigger for that was actually the trade war and who's going to win the race for the 5G. So you will see on the left-hand side that tension really was sparked between the US and China in the race for who's going to be the winner to the trade war. Lots of controls on chips, lots of controls on data security. That's really where it was the origin. But if we fast forward to today, with all the news that's been happening for this year, you are seeing on the right-hand side of the slide a lot of the discussion on the reciprocal trade tariffs, which has really increased the attention and the pressure on supply chain. We have tried to update this slide on the right-hand side based on what we saw last week. It is actually quite difficult to have this updated on a daily basis. So I'm aware that certain things have already moved. We are seeing hopefully a new trade deal that should come out with more clarity for China. Some of the rates have already dropped between the US and China starting from Monday this week. India is rumored to be on the cusp of a trade deal, as is Vietnam. So really, everything you're seeing on the right-hand side and those percentage numbers, they will continue to move. They will continue to evolve. Now, we talked about kind of, tariffs and what they have and the impact that they have on trade. But of course, it's not just on trade. Dolly, can I maybe bring you in to talk about how you're seeing tariff changes on other industries and in other parts of Southeast Asia?
Sure, Sarah. The audience, we do observe this tariff dynamics are having tangible consequences across the industry sector and supply chain. For example, the high tariff are making uncertain export commercially unviable. Taking solar panel as an example, solar panel from Cambodia is now facing tariff as high as more than 3,000% due to U.S. anti-circumvention rule on Chinese solar panel giants. This also brings operational disruptions. Cambodia's garments export fell 30% year on year, with over 50 factories temporarily closed. In Malaysia, we also read from the report that 40% drop on solar panel orders affected more than 10,000 jobs in Pampang. Some companies are reshaping their manufacturing footprint, such as some Chinese electronic vehicle battery makers. They are shifting 30% of production from Malaysia to Texas in the US, invest $450 million in the US facilities to avoid the tariff in the long term. Some companies are reshaping. We also see that the logistic costs have risen 20 to 25% in Vietnam due to rerouting and customs delays. And Singapore's port for the US outbound goods has been increased by more than 15%. Meanwhile, stockpiles has driven warehouse occupation in Ho Chi Minh City to 92%. Mike, do you also have similar observation in some other topics?
Thanks, Dolly, and hello, everyone. A pleasure to be speaking with you. I think that my observations correlate with yours. I'd add a couple of points, perhaps. Firstly, on the operational disruptions that we've seen to many businesses in the face of uncertainty on a day-by-day or week-by-week basis, that obviously affects business decision-making, and that's led in some cases to falling exports or falling imports into the US from their perspective, given the often shifting points of production and points of supply to the US market and the operational disruptions such modifications entail. And also, more generally speaking, with the higher cost being necessitated to supply the US market due to the tariffs, that's also affected both consumer prices and consumer demand, and then also reduces the amount of shipping US-bound cargo. For example, we have about a 33% drop in May 2025 of container volumes at West Coast ports from Southeast Asia. And then that's quite a significant change in and of itself. In addition, we see businesses do inventory planning, as we've discussed already. So that might involve front loading the production of inventory and shipping inventory in certain cases to the US in order to benefit from things like pauses. And so it's quite a tactical approach driven by the highly uncertain environment in which businesses face themselves in. So perhaps then, if we move to the next slide, we can see some broader structural strategic changes that businesses are also considering over time. And we've put this through a few different lenses as we've started this. So if I go to the third row first, where we look at different strategies that we have that companies adopt, a mixture of approaches here to achieve chain resilience, depending on the business context, depending on the markets that are critical. Where we have businesses where the US market is a very important market. For example, let's say we have Chinese M&Es that are looking to ship to the US, and that's a very important market for those businesses. We're seeing many of those businesses go outbound of China and set up manufacturing outside of China, or essentially outside of Greater China, to supply the US market. So they're effectively not supplying the US from their China sites and are doing so from sites outside of China in order to reduce exposure to those geopolitical tensions that we've described. However, that also has some potential cons in terms of the operational difficulties that it has to get that off the ground. The transition into that new model obviously has challenges of its own, and also there may be issues in getting and attracting, keeping talent to go in the manufacturing sites in those new locations. And of course, there is the cost consideration that's paramount as well. Moving outside of the original site, whether that's in China in this case or in other sites, through to a different one, obviously has the potential to increase operating costs to supply outside of the tariff consideration too. So we see businesses consider these type of situations, would obviously look through the various pros and cons together when determining where that location is. And in particular, Southeast Asia is quite a popular choice. Then we also see, kind of similar to what's happened maybe in China historically, we see many businesses place manufacturing in the US, or at least are considering placing manufacturing in the US to supply the US market. So having a local to local approach in large markets like the US, maybe also China, in order to mitigate trade and tariff tensions, reduce obviously the risks of supply chain disruptions, and then have non-US sites, the original sites effectively that have been supplying the world previously, still supply the rest of the world where trade tensions are a little less apparent. So in that, obviously, you get access to the US market more readily, and you're not exposed to the geopolitical tensions because it's within the jurisdiction. However, of course, those manufacturing plants may operate at an even higher cost than many other jurisdictions that would be competing locations. And there again may be a gap for talent in the manufacturing sector, given the diminishment of the US manufacturing base over time. So Dolly, do you have any further comments and considerations on the China situation?
Yes, indeed. I think China is both a very important market as well as the manufacturing site. And therefore, many companies have already adopted China for China or China plus N strategy back to Trump 1.0. For China, maintain the benefit is to maintaining the local manufacturing, to leverage China's technology, very sophisticated supply chain to serve the domestic market. This offers regulatory alignment as well as market customization, but this could increase the exposures to China's economics and fluctuation, as well as some concerns from IP perspective. Nowadays, we also see many multinational and Chinese companies considering China plus N. This means diversifying production across China and other regions, especially leverage the free trade agreement in the APEC region. This will help to reduce reliance on one single location, but it could lead to duplicated systems and higher coordination efforts. Therefore, there's no one single solution, but there are various strategies to build resilience. So next slide, over to you, Mike.
Thank you very much, Dolly. So here we see a number of responses that companies have been engaging in to mitigate some of the harmful trade tensions and tariffs that we've seen. A very common consideration that we see businesses having entered into is on the pricing side, in the sense that it's obviously a business critical issue to determine the price point with their external customers, because their existing contracts, for example, may contain clauses on who would bear the cost of tariffs now. But if those costs have dramatically increased, that may lead to some type of negotiation. And also on the sourcing side, there's a similar negotiation with the suppliers of businesses to see who bears the cost of the tariff. That's also a consideration, of course, within the group itself, as in which party within the group's intercompany transactions should be bearing any tariff costs as material or finished goods are supplied from one jurisdiction to the other. And this lends itself to a number of different challenges too, sense that isn't an easy thing to observe in third-party behavior, and so is also a difficult thing to impart in the related party transaction context. We do also see inventory management strategies, which obviously have implications from a transfer pricing perspective. For example, if you have a limited risk distributor in a market that's supposed to have low inventory, if it gets inventory front-loaded to it and it has to bear and manage that inventory, then it can challenge the transfer pricing characterization for that entity. And so a few different things we could think through. Obviously, establishing offices in the US is another strategy that we've seen in order to reduce to some extent the tariff by having the lower cost of goods being supplied to that entity, which takes some of the profit to ultimately supply to customers. But most commonly in the uncertain environment we found ourselves in, we may see businesses undertake individual strategies here or there on a tactical level, but when it comes to the longer run, more fundamental strategic decisions, many wait and see to see what the ultimate landing zone in this negotiation is going to be. So Dolly, what are your perspectives on these issues that you've seen for mitigation plans?
Yeah, based on my talking to many supply chain and tariff people, supply chain re-engineering is a hot topic. Many companies are considering rerouting production to lower tariff jurisdiction. But under current complex situation, they will also be very careful to make sure that as a result of the re-engineering, they do obtain the qualified certificate of origin in the new location. I also see many companies are considering to optimize their product portfolio. This means they can shift demands to less tariff impacted SKUs. From commercial perspective, some company, they are also trying to renegotiate the contracts, especially be specifying on the in-code terms to shifting the tariff liabilities. From a pricing strategy perspective, some companies are discussed with their business partners who should absorb the tariffs or share the costs with the customers. Of course, I think for supply chain and inventory perspective, there are also many planning around to have inventory buildup in low tariff or end markets. And there are also some companies still adopting a wait and see position because there are so many changes. But they are not just doing nothing, but they are actively review their own status so that they can have a basis for the scenario planning. So Sarah, I pass that to you. Maybe we can ask the audience some of the polling questions.
Factors, both internal and external pricing pressure, which is creating a difficulty for us. Can I just check my mic is okay?
Yeah.
It is now. We missed the opening part of the question, Sarah.
I'm sorry. Hopefully you can read the question. The question is, what is your top concern that you have from a tax and supply chain perspective? 5 answers, please pick just one. I'll quickly just go through to the remaining answers for time management perspective. Second one is real concern regarding tax planning, how to conduct risk assessment, getting some visibility into true tariff costs and uncertainty of what those costs will be, moving fast to address new regulations, and I don't know. I'm going to allow a little bit more time for everyone to vote their answers. But we actually have Dolly and Mike here for special reasons. The first is Dolly from our China firm. China is one of the few countries that have executed retaliation measures against the US. Mike is based in Singapore, and I'd like to address the question to Mike. Mike, from a Singapore SCA perspective, I haven't seen too much in terms of retaliations. Can you give some comments about your views on what is going on from a Southeast Asia perspective in Singapore?
I think, thanks very much for the question, Sarah. It's a really interesting one. I think that geopolitically, Southeast Asia obviously views the US as a very critical market for product that's manufactured, that's originating within Southeast Asia, so wants to obviously maintain strong geopolitical negotiations and negotiate over time reductions to the high tariff costs that have been imputed. And we saw that obviously the original tariff calculations back several months ago were extremely high based on the bilateral trade imbalance essentially between the jurisdiction relative to the US. And I think that over time, their strategy has been to try and talk down that tariff rate over time and maintain favorable relations to the extent they can. And they've taken a softer negotiating strategy to manage that process. They also obviously see great potential for Chinese inbound investment as well to supply the US. So do treat it obviously as a critical matter to reduce the tariff rate rather than let's protect the revenue base. I think they've seen politically the most favorable means of doing that is having a constructive negotiation with the US rather than taking a more adversarial political approach.
Thank you, Mike. The results have come through, and I'm not surprised. We're seeing that the top concern is actually tax planning, risk management, and ETR management. We were hoping for these answers because that's actually why we have brought Mike and Dolly together. We feel that there is no single tax lever that you can pull. You actually have to consider all the tax costs across the whole spectrum for the supply chain to have a good answer for you. So this is what we were hoping for. So maybe I can just move on to the next slide. Dolly, maybe you can talk us through a little bit about some of the work that you've been doing. You talked about kind of customs mitigation strategies. Maybe you can talk a little bit about kind of how you're seeing what our companies are doing and how this is playing out in the actual world.
Sure. This is a good question, Sarah. And actually, this is the same question many tax professional or trade professionals are facing internally from the top management. From a starting point, companies must assess their current supply chain exposure to trade tensions. This can be done by mapping import-export transactional data, identify the country of origin, verify the customs code classification, and also determine whether tariff apply and how much the tariff apply. Our suggestion is companies should prioritize those high volume, high value items for risk assessment and monitor development across key trade corridors and political flashpoints to concentrate the risk evaluation efforts. This fundamental analysis would enable informed decision making. Once exposures is understood, company can then pursue several mitigation strategies. In the short term, they may temporarily reroute production or sourcing through alternative partners to reduce immediate duty impact and improve the lead time uncertainties. Front-loading inventory from higher risk sources will help avoid impeding tariffs as seen in Vietnam's electronic sectors in early 2025. Firms can also negotiate contracts with suppliers, leverage change in regulation clauses to share cost burdens or adjust pricing and delivery terms. There are some other levers, including customs valuation planning, such as separate non-dutiable elements, for example, the post-importation services, and exploring bounded warehouse or free trade zones to defer the duties. Next slide. Yeah, so I think I've introduced some of the solutions, but from a timing perspective, I think a very comprehensive tax optimization or tariff reduction strategy would normally include short-term and long-term levers. Each options will require careful analysis of the rules of origin, product classification, and also the pricing methodology, both from a trade and transfer pricing perspective. You can see that on a short-term basis, by applying for any exclusion or exemption policies, for example, for import into the US, there are 20% US content exemption that can be leveraged. Companies can also consider adjusting declared price by including the non-dutiable elements, which I just explained earlier. Also, there are some methods such as the first sale for export rule can be adopted for import into US to declare a lower customs value based on earlier related party sale. Of course, there are also long-term strategies, which I will pass to Michael for further elaboration.
Sure. Okay. Thanks, Dolly. I think when we talk about short-term relative to long-term measures, obviously there's a grey area as to what we really mean with that dividing line. And typically we might look at long-term measures as the time horizon over which we can effectuate more fundamental business change. And that's why we focus on the more strategic areas like product portfolio optimization. Where are we thinking as a business in our product portfolio? Where do we ship? What markets do we focus on, etc. But then I'll focus a little more on the supply chain transformation side. Some of our examples later will cover some of the situations that we see our clients considering in terms of more fundamental restructuring of their supply chains to make them more resilient in the face of the current trade and tariff tensions. And I think one meta point I'd like to raise is also that the prioritization over time on supply chain resilience and robustness over purely optimization. Now it's somewhat more of a constrained optimization problem in the sense that if having, let's say, a single point of supply to a market increases vulnerabilities, increases the possibility of bottlenecks or higher or more volatile tariff costs, then even at the expense of some operational efficiency, we do see businesses considering having multiple points of supply going into those more sensitive market jurisdictions. We'll see a number of tax, customs, and transfer pricing trends from the policy and regulatory environment that also is having some combined effect on how businesses perceive the robustness and resilience of their existing supply and value chain. For example, with the Pillar 2 regulations coming online, that reducing the effectiveness of tax incentives, then we do see some businesses, for example, seek to change the holding location of their intellectual property and re-domicile that to a headquarters jurisdiction, as well as moving functions like manufacturing to have more of a local to local model in that same jurisdiction. And that might both mitigate tariff exposures while having not that much of an impact on the effective tax rate for the group, but also simplifying some of the administrative and tax admin procedures too. So we'll cover in the examples what some more of those trends mean. And perhaps now, Sarah, I'll hand it back to you to go through the next set of slides on those tax implications.
Thank you, Mike. In the earlier polling question, we kind of asked you what were your main concerns, and the answer was that it was really trying to balance your ETR, balancing with different tax costs. So we actually looked at supply chain holistically. And in the next slide, we try to lay out the kind of end-to-end tax issues that everybody has to be aware of. If you can help me move to the next slide. For us, the end-to-end is really covering all the tax issues shown on the spectrum. In terms of managing costs, especially tariff, Dolly and Mike is going to talk you through some of the tools that you have, but many of them will be looking at where you house the IP. And to the extent you may want to reevaluate where you want to have the IP, but immediately when you do that, it's going to lead on to transfer pricing considerations. Over the past year or so, the three of us have been working quite closely because whilst there are transfer pricing discussions, that immediately opens issues in customs. I think Dolly mentioned about balancing things earlier. I would talk about supply chain management as having to negotiate between each other, because one thing the team will be drawing out for you in this webcast later is how you balance some of the issues between transfer pricing and customs. What works in one may not work in another, and there has to be a constant evaluation to get that correct. Indirect tax and sales tax will hit on all your transactions. So if there are repivots on where you buy from, where you sell to, the VAT costs will have to be considered. Withholding taxes, I'm not going to go too much into that. Of course, that's very clear. In terms of location strategies, many of our clients are thinking to move manufacturing to another location. That was a point that was raised by Dolly and Mike earlier in terms of China plus N and the rest of the world. Need to look at any tax incentives that there could be locally to attract inbound investments. And immediately when you look into that, I think the final point that we want to make, which is really what we're focusing the rest of the next 30 minutes on, is really how do you find that balance between the two front runners in terms of tax issues for supply chain, which is customs and transfer pricing. So for us, this is the end-to-end spectrum that we foresee. And we're going to start taking you through some case studies or some examples to highlight this. So I think just to start that discussion on what is the interaction between TP and customs, Mike, can I ask you to talk through the next slide?
Sure, thanks very much, Sarah. And so, as Sarah's already highlighted, that there are many really critical interactions between customs and transfer pricing. As a technical matter, obviously, transfer pricing is focused on determining the transfer price for goods, services, or capital paid between related parties in a transaction. And of course, that ends up at a product price, let's say, in a physical good environment, and that may have implications if that is not fully harmonized with the customs valuation of the goods relative with customs valuation rules, as TP and customs operates under a different set of rules. But even if the transfer price was acceptable as a customs value, which shortly, then obviously the transfer pricing policy that we establish in the intragroup context will then have really significant implications for the amount of duty payable. If we think of very common structures to have, let's say, a limited risk distributor in a market jurisdiction, a critical issue to consider in a high tariff world is the sense of having that structure, in the sense that you effectuate the transfer pricing model through having a higher product price charged to the distributor, which reduces its taxable profits. However, that may lead in a high tariff world to a higher customs valuation, assuming that TP is acceptable, and then that leads to a higher duty cost. Many of us see quite frequent issues also in making transfer pricing adjustments. Of course, when I am invoicing my related party distributor for the goods I supply to it, then that may be depending on some forecasts of demand, pricing, or costs. And that may need to be iterated based on the confrontation with projected and actual data over time. And so therefore, I'll be constantly adjusting prices prospectively or retrospectively through that cycle. And that also has customs implications in the sense that if I adjust product price retrospectively, then it may affect past customs values. Likewise, will prospective TP adjustments be acceptable given their impact on the customs valuation? And so the greater that variance, the greater the loss of control over that process, the greater the issue that may occur when trying to reconcile customs and transfer pricing, administrative and policy standards. Then, in addition, you may have info in the transfer pricing documentation that may affect the acceptability of the transfer pricing policy for a customs value. So it's important to consider between TP and customs what information is available in order to justify the value, and do the relevant information reconcile in terms of what the proper valuation approach would be between each of these two different standards. And lastly, as we'd intonated earlier, intellectual property planning is quite important for customs and TP issues and valuations. Where we have, for example, intellectual property centralized and embedded within the product price of a good, that obviously leads to a higher product price than if that intellectual property was unbundled, for example, and charged to a distributor from a separate entity. And so there are a host of transfer pricing and customs implications of that. And Dolly, I'll hand it over to you to take that forward. Any further comments on customs and how that process would work?
Yeah, sure. I think now we are in November, so there are increasing inquiries on whether I can make retrospective transfer pricing adjustment on the past 10 months. If not, can I adjust all of them in the remaining 2 months, or I have to bring that to the next year? So Deloitte has been doing for over 10 years a global survey on the customs attitude on transfer pricing adjustment. And I will say that for the APAC region, overall speaking, it is a very challenging topic because overall speaking, the APAC region, the customs acceptance on TP adjustment is limited. And especially in some of the jurisdictions, there are also foreign exchange control, which will make the money flow even more challenging. Therefore, careful plan and also mild, true up within a year might be a better recommendation. Mike have comment on the intellectual property planning, but I would like also to point out that from a customs standpoint, especially for the very aggressive customs in the APAC region, the so-called non-trade payment, for example, royalty, warranty, service fee, are also subject to a very close scrutiny by the customs authority, because they are looking to include that for duty for value purpose. Therefore, we always see the frustration by taxpayer of being in a dilemma to have double taxation on both ends. Therefore, I think the alignment between transfer pricing and customs are quite crucial. If we move to the next slide. Yeah, so I think these are some of the tariff mitigation plan that we also touched base on a little bit in earlier stage. In the high tariff world, I think many companies are looking for reducing the tariff. This strategy will including planning on the price, which we have already illustrated. In addition, there are exclusions, exemptions, as well as applying for certain pricing policies, such as first sale for export. From a longer term, consideration can be taken to restructuring the overall supply chain in order to change the country of origin, as well as utilizing the multiple free trade agreement and preferential policies in order to mitigate or reduce the tariff cost. I think these are all the suite of tools can be done, but we'd like to use 3 real cases to better give an example. So if we move to the next slide. Yeah. We have planned 3 examples on tariff mitigations. The first one is the interaction like between the transfer pricing and customs by using the first sale for export. As you can see, when a principal company charge the related party, like having the related party distributors, they can sell to a supply chain principal who then onward sell into the distributor into the US for import. Under the US customs rule, it is allowed for using the first sale price into the US as the basis of calculating the duty. This means if we have satisfied the criteria, we can actually using the selling price between the manufacturer to the supply chain principal in Singapore in this case as a basis in calculating the duty payable back in the US. There are 3 fundamental requirements that needs to be satisfied in order to apply this first sale rule. Firstly, I think this should be a bona fide sale. It should be very, this should be a true transaction supported by all the documentation. The goods should have a very clear designated for export to the US, for example, from the contract, from the labeling, and also from the product specification. It can be clearly seen that the goods are for the US market. Last but not least, I think it's very important that if there are transactions between related parties, this needs to be an arm's length transaction, and any addition to the values should be reflected in the first sale value in calculating the import duty into the US. I think there are several critical issues to consider. Mike, would you like to talk them through?
Yeah, I think this obviously is a specific planning point into the US market. I think from the transfer pricing standpoint, there are a few interesting considerations here, as to how this might work. Of course, we need an arm's length transaction, which is of course, arm's length standard for transfer pricing. So when we evaluate the transaction from the manufacturer through to the supply chain principal, it's important to undertake careful due diligence to establish the arm's length nature of that price and set and monitor that price accordingly. I think there's another interesting perspective around the model itself, in the sense that a contract manufacturer here, would make a sale to the supply chain principal, who would on sell to the distributor, whereas a toll manufacturer do a relatively similar thing, although without obviously purchasing its own raw materials or effectively selling the product would not be making a sale through to the supply chain principle. And so, based on that reading of the conditions, it's important to make sure, and perhaps plan around the situation of, is it possible to reevaluate the manufacturing model to make sure that it qualifies for the first sale for export conditions. Then, in addition, we obviously have also the profit and the price that's charged from the supply chain principle to the distributor. In this example, the numbers and the differences between the first and second sale prices are quite stark, reflective of the value add that the supply chain principle has. Of course, we're really focused on the first sale price here and justifying that, but the arm's length principle will need to be satisfied all the way through the title chain, from the first and the second sale in these transactions before the distributor ultimately sells on to the third-party customer. So a relatively popular route of consideration in this instance, because it might not necessitate really fundamental business change, but can, if properly deployed, significantly reduce the customs value going into the market jurisdiction. So perhaps now we can move through to the following slide, where we go through another example of the interplay between customs and TP, where we talk about essentially bundling and unbundling. Here we have a slightly different structure in the invoicing and the intercompany transactions. We have a supplier manufacturer with raw materials, and then those raw materials are manufactured into a finished good that is imported to the related party distributor, who then sells those goods to customers. The physical flow usually would go directly from the manufacturer to the customer, but also could go through to the distributor as well, who keeps it in its warehouse. But broadly speaking, the idea. So in this instance, the example looks at a situation whereby the principal company offshore from the distributor and the manufacturer owns intellectual property and performs services for those parties and charges royalties and charges services fees to both the manufacturer and the distributor. So I think this has happened in many different situations from a TP standpoint. If there is a good reason from a transfer pricing perspective exclusively, that would necessitate the separation of the charge for royalties and services from the product price. So we're essentially unbundling the service and royalty component from a TP standpoint from the product price. There are significant withholding tax customs implications of undertaking that type of planning. And perhaps, Dolly, then you can further elaborate on that interaction for the remainder of this slide.
Yes, Mike, I noted that in the left box, there are like warranties, software updates, as well as the royalties, and all those will be a very eye-catching wording from a customs perspective, because customs are always carefully examining those payments to see whether they are potentially related to the imported goods, especially in the APAC, because normally in the APAC, the burden of proof lies with the taxpayer or the importer. The customs will normally deem those as dutiable unless the importer can prove otherwise. And therefore, I think when we are considering unbundling, it's very important to check the local customs regulations. For example, I will say royalty and warranty in 70% cases may be a no-go. Certain fees, such as training fees and technical support, may be more likely, but this will need to be very carefully managed, both in the contractual terms, how to define the deliverable, to have a very clear distinguishment from the goods that are going to be imported into those jurisdictions. Okay, with that, I think maybe we move to the last examples. This is so I think this is this illustrates a transaction whereby the multinational company are reshoring the manufacturing operations back to the US, particularly if they are targeting the US or North American market. In this diagram, a US based manufacturer producing goods for US customers, while a US principal managed the distribution to the Singapore and other regions from Asia, sourcing access to the US incentives. So, Mike, do you see this quite often, especially in the Southeast Asia region? And what are the key considerations that we should bear in mind?
Thank you, Dolly. And yeah, we have seen more US, particularly US-focused multinational groups evaluate whether they should do a domestically focused value chain for the US market. I think that's something we've seen more M&E groups consider. So it could be not just ensuring manufacturing to the US, supply US customers, but also to reshore IP and a fully integrated domestic value chain for the US, with the residual profits being kept there, and also include the world as well. And in this example, you'll see that all IP is in the US, and the good of the world operate essentially as distributors for the finished good in their different markets. So in this situation, one of the drivers behind these type of decisions has been US tax reform combined with Pillar 2, such that the basis of US tax reform and the international tax system now means that combined with the Pillar 2 impact on tax incentives has meant that there's not really a significant gap on the effective tax rate between ensuring the IP back into the US relative to keeping it in an offshore hub. And it also simplifies certain aspects of tax administration if the IP isn't kept in a jurisdiction, for example, where later on that might be subject to top-up tax under Pillar 2 if its effective rate is below the 15% minimum. It also may be seen as being more sustainable from a transfer pricing perspective to hold the IP within the US if other DEMPI functions with respect to the IP are driven from there. It may also be seen as a defensive measure in light of existing and historical tax audits to stop that type of situation from occurring in the future that might lead to double tax. So these things, combined with the possible duty saving of having manufacturing and supply domesticated in the US, is something we've seen quite a few different companies consider and evaluate. So perhaps, Sarah, I'll hand it back to you for the next part of the discussion.
Thank you, Mike. So we're just going to quickly move to the next polling, the second one for today and the last one. But based on what you've heard from Dolly and Mike, we tried to just zoom in on what we call solutions for supply chain. For us, we're grouping them into so-called short-term and longer-term solutions. So short-term will be easy things that you can do now without having to go through changes in your supply chain. The longer terms are things that you may be expecting, but it would be a bit more difficult to execute. Dolly, we talked a lot about customs on today's call, and I know you've been quite busy lately. So let me ask you, if I asked you, what is the top planning opportunity that you're seeing clients are doing from a customs perspective? What would you say would be your top answer? Would it be first sale? Would it be unbundling? Would it be something to do with the country of origin? What would be your view?
In my observation, especially for export into the US, first sale is quite popular because it is still supported by the US customs regulation. And compare with restructuring the supply chain, it is more easy to achieve. Having said that, many companies, they are also have concern that if they have big volume coming into the US using their first sale, whether there will be any post-importation audit. So many companies, they aside from themselves reviewing whether they have satisfied all the three requirements, they are also looking for the professional support on the reasonable care memo, as well as like for some brand company, they also wanted to have some plan to audit their supplier or vendors to make sure that they are not being revoked on the first sale opportunities.
And Dolly, do you think first sale will still become available because the US have revised some of their rules, so the low value consignment exemptions were removed? Do you think first sale will continue for some time yet?
I think so. It will still continue for some time. Yeah.
Thank you, Dolly. So the answers have come through. We've actually asked this question several times to our clients, and I think in almost all cases, the answers are very much what we're seeing here. The top answer is that many of our clients are still in what we call the wait and see mode. The reason for that is there are lots of evolutions in terms of trade deals, which is affecting the tariff rates. And it is difficult to actually put together planning, especially long-term planning, and the cost in doing a long-term planning. And hence, what we're seeing is that the companies are all assessing the short-term solutions that we can do and doing a scenario planning to see what they can expect and be ready to pull the options as needed. So this is actually quite in line with what we have seen. And just in the time available, I'm just going to quickly wrap up as a summary what we're hearing from our clients in view of all these trade discussions. So again, having done some surveys with many of our clients, many of them are considering the scenarios, so doing scenario planning on what are the options available for them. Because I think although there are evolutions in the rates, there are trade deals, it is quite clear that these tariff costs have gone up and they are going to stay for a period of time. And it is difficult to actually have those costs sat within the company, also going to be difficult to completely pass on to the customers. So with that realization, many companies are assessing what levers they can pull short-term and long-term, and it's all been scenario planned. The longer-term solutions, such as relocation of a manufacturing, is perhaps a little bit more difficult to do. As Mike said earlier, it's not something that you can easily do without having a good thought process around it. And we do have to consider whole end-to-end tax issues as well. So in terms of the strategies, all our clients, they're either in a wait and see, but very soon after, they're all into the planning mode. So with that in mind, I think my time is up and I need to wrap up the debrief for today. So Michael and Dolly, thank you again for all your time, and special thanks to all of you who were able to join us today. We'd like to encourage you to fill out the short survey that will pop up on your screen momentarily and tell us what you think about today's program. If you joined us late, please note that this presentation will be archived for future viewing. And if you feel that others would benefit from this webcast, please share the webcast via the share this icon or have them visit the Dbriefs website. We will aim to respond to all the questions submitted during today's webcast in the next couple of weeks. Also, if you think of any other questions or comments later, please feel free to reach out to myself or to Dolly or to Mike. We'll be more than happy to address them with you. And please don't forget to tune in to our next scheduled webcast from the Geography series on the 20th of November. It is titled SC Ruling on Hyatt, covering PE implications and profit attribution. Finally, from all of us at Deloitte, thank you once again for your participation in Deloitte's Asia Pacific Tax webcast today. Thank you and goodbye.